I've only been in Vegas for 3 days. What the hell is going on with interest rates? When we get back, we'll talk about how interest rate spike affects you. Stay right there. I'll be right back.
You were talking about money, right?
Separate yourself widely from the pack moving forward. Is that something that you would be willing to have a discussion about?
Because they didn't get it.
They
were
probably
like,
didn't get it. Yeah.
To follow up with your clients to generate more leads.
Happy Monday. Welcome back. This is your daily Millennial Mortgage update, and I'm Mark Jones, your Millennial Mortgage expert, branch manager of Directions Home Loan at Cantera, host of Key Factors podcast, and co-founder of ReviewMyMortgage.com, the largest index of mortgage programs nationally. I'm coming to you live from Las Vegas, Nevada. And today we are going to be chatting a little bit about the interest rate, the spike, how it affects you, and moving forward. So I wanted to give you guys a different perspective. Then we've got a pretty good article in addition to a little clip that will give both mortgage professionals and real estate professionals a little bit of perspective of what's going on in our market. So let's jump straight into our interest rate of the day. And since I am actually in Las Vegas, Nevada, I wanted to mess around and play with some rates from Nevada to just compare between Nevada and Texas. So quickly, let's go over to 300,000 loan amount with 5% down, and we are shopping in Nevada as of today with a credit score, and we will compare it as if it was Texas. Let's go with between 660 and 679. We are sitting at a 4.827 rate. And that is for a 30-year fix. So now let's jump over to Texas and see how that compares. With Texas, we're looking at a 4.848%, and that is with the same credit score. Now let's jive up to the above 740 credit score. We're at a 4.22 in Texas, and in Nevada, right around the same. Okay, so that is a tremendous leap from the day before. We definitely, the previous week, were creeping into the 4%. But as you see, in Texas, we have an average credit score of 676. So that is showing an interest rate of 4.827. And that being said, guys, they're on the rise. There's no surprise. I've been talking about it for quite some time now. And I believe that the article of today is going to put a little bit of things into perspective. So without further ado, let's jump straight into that for today. And the article is entitled Current Mortgage Interest Rates, February 10th, 2022, mortgage rates start to climb. And I think it's funny because they say start to climb, but rates have been climbing for quite some time now. It says, for anyone in the market to buy or refinance at home, it's a good time to lock in a low rate. Mortgage rates rose today, but rates overall are at a historic low. And I think it's important that we give you guys perspective for those of you that are new to the market of purchasing a home, and those maybe that have forgotten what history has shown us. So on the screen here, you can see that I have brought up a graph which shows historic interest rates from 1975 all the way to 2021. And as you can see, from about, I would say, 1987 to 2009, so from 1987 all the way to 2009, rates did not get below 6%. Just to kind of give you perspective on the whole pie, for the last 10 years or longer, we've been spoiled. We've been spoiled with low interest rates to combat the mortgage crisis that took place, which invigorated the market. But at the same time, it left folks like myself, the millennials out there, in a skewed judgment of actual reality. And what I mean by that is we've been spoiled with these low interest rates for quite some time. Our parents' parents didn't get an opportunity to purchase as much home as we are actually able to do at the moment because interest rates are still low. So that being said, I want to play a quick clip for you guys from the CEO of Loan Depot.
But if you have that kind of optimism, if you think you can do that, where's the disconnect between investors? Because your stock is not just having a rough day, but a rough year.
So in addition to our $11 trillion of overall industry volume, last year, because of low interest rates, the industry broke an all-time record, Diana, over $4 trillion of business. We're adjusting to a forecast of $3 trillion this year. So there's excess capacity in the industry that needs to shrink down or adjust down. And while that's happening, there's a lot of pressure to margins because people are becoming very aggressive in their pricing structure, but that is not sustainable. Your strategy is, and the barrier to entry is going to limit new players from coming in. So this is just an adjustment, and this is not anything new, unfortunately, but it is part of the natural process, and the market just will get larger as we come out to the other side.
All right, so what does that all mean? He mentioned a couple of things that stand out to me, which are margin compression. He also mentions expansion and contraction, and essentially there is an overabundance of operations staff for the amount of volume that was coming through the door. Essentially, with the rates as low as they were, there was an exuberant amount of refinance opportunities available to customers, and big name companies like your Loan Depots, your Wells Fargos, things of that nature were truly losing their focus to shift towards more of a refinance potential capture. Because mortgage rates were so low, you had, let's call it, players in the business that wouldn't typically be in the business capturing the business that they were. Anyone who was anyone in our industry had their best year in 2021. As we head into 2022, all of those that were focusing merely on the refinance side of things have to learn how to get back into the purchase sector, which I can tell you that my branch locally in Texas, we only had an 18% year over year shift to purchase to refinance. We always focus on our purchase volume. That helps our industry grow. It helps the folks around us grow. And we do definitely help those previous customers that are looking to refinance their home to save money, lower their terms, get out of mortgage insurance, things of that nature. But it's an obvious indicator that there are going to be some layoffs at the bigger mortgage companies around the United States, simply because there's not enough volume, margins are shrinking. And then there's one other thing that he mentions in here, which is market compression. And I want to go over market compression and what it means. Essentially, when you have interest rates that are rising, you've got a big pool of mortgage companies that are competing, and it's almost a race to the bottom. There are companies out there that are willing to take a lot less in order to keep the business coming in. So that is a period in time that, as he mentioned, is temporary, and it also happens quite often, and it's only sustainable for so long. So those of you mortgage professionals out there that are frustrated with getting beat in pricing with these bigger mortgage companies, it's only a matter of time before they too have to adhere to what's going on in our market. Unfortunately, it's going to require them to have some job layoffs in order to trim the fat around what their operations have. It's something that I've experienced a couple of times within the last 10 years of being in this industry, which is the expansion and contraction of our industry and the flow of what comes through the door and why it comes through. I don't know, some good things coming out of that interview there. So that being said, guys, I hope you get a little bit out of these articles that I do daily to give you guys a little bit of perspective of what we do in the mortgage industry, in addition to the real estate side of things, to give you guys perspective from a broader scale. And if you like these videos, if you listen to this podcast, please share with a friend, like, subscribe, make sure to hit the like button. And thank you for your continued support. So I'm going to continue to enjoy the day here in Las Vegas before we head back tomorrow. But as always, this is Mark Jones, your Millennial Mortgage expert, and you guys make today count.
You were talking about money, Mark.
Separate yourself widely from the pack moving forward. That's something that you would be willing to have a discussion about.
Because they didn't get it.
They
were
probably
like,
didn't
right.
get it. Yeah.
To follow up with your clients, to generate more leads. You know what I mean?